A lot of investors opened their trading apps this morning and felt their stomach drop. Gold gapped down again at its intraday low. It briefly touched $4,670, threatening the critical $4,660 support level. By the time this piece was written, price had held above that line, but the gap itself left plenty of people who chased last week's rally sweating through their morning coffee. So why the gap? Simple. The U.S. Iran talks fell apart over the weekend. More precisely, both sides looked at what the other handed across the table and threw it right back. Trump went public saying Iran's response was completely unacceptable. Iran's side fired back just as hard, essentially saying no one was going to draft a proposal just to satisfy Trump, and that his disapproval was almost a badge of honor. Picture two people at a negotiating table. One slides a draft agreement across. The other doesn't even read it, just tears it up and flicks the pieces back. That is the energy this weekend had. Any hope for a ceasefire got a bucket of ice water dumped on it in real time. Oil responded immediately. WTI crude shot up more than 3% at the open, blasting back above $99, and gold, it gapped down nearly $30. If you've been paying attention to how these markets connect, the chain reaction here is almost mechanical. Oil spikes, inflation expectations, climb the Fed's room to cut rates, shrinks the dollar and treasury yields find support, gold gets squeezed. This sequence has played out so many times that at this point, the script practically writes itself. This morning's gap was the script being performed again, with no ad-libbing whatsoever, but the gap itself isn't really what I want to talk about. What matters more is what comes after it. Before we get to what happens next, it is worth revisiting Friday's non-farm payrolls report, because it is directly connected to this morning's price action. April added 115,000 jobs, well above the consensus estimate of around 65,000. The prior 2 months were also revised upward by a combined 16,000 on the surface. That is a strong report. Strong enough that gold should have dropped. Instead, gold closed up about 0.8% on the day. Why? Because markets didn't stop at the headline number, they dug into the report and found the more important signal. Average hourly wage growth came in at 3.6% year-over-year, below the expected 3.8%. In the Fed's framework, slowing wage growth suggests inflation's stickiness might be easing. So the market processed a seemingly bullish jobs print as actually less inflationary than feared. That reaction tells you everything about what markets are really paying attention to right now. It is not whether employment is strong, it is whether inflation can be contained. The slightest dip in inflation expectations gives gold room to breathe. Any tick back up chokes it. Friday's session confirmed one half of that logic. This morning's gap confirmed the other half. Which brings us to the central question: is this gap digging a hole to bury latecomers in, or is it opening one last door before the next leg higher? To answer that, you have to understand what is really happening geopolitically right now. And the honest read is, both sides are posturing hard, but neither has the stomach for an actual escalation. Look at Iran's demands. They want the U.S. to lift oil sanctions within 30 days, return frozen assets, pay war reparations, and, most provocatively, formally acknowledge Iran's authority over the Strait of Hormuz. That is not a negotiating position. That is an opening bid designed to be rejected. They priced it like a street vendor who knows you'll haggle. Now look at Trump's response. He said it was completely unacceptable, but read the actual language closely. He said he didn't like it. He didn't say he was resuming large-scale military operations. He didn't say the ceasefire was dead. The tone was aggressive. The action was minimal. Netanyahu added some theater, suggesting Iran's enriched uranium could be physically removed, while simultaneously refusing to give any timeline or specifics for how that might happen. That is a fighter at a post-match press conference saying he'll knock the next guy out without being willing to say who, when, or where. Every word from both sides is calibrated to sound tougher than the action behind it. When you read between the lines, you see two parties who know the real costs of full escalation and want no part of it. Trump can't afford an oil price explosion heading into the midterm cycle. Iran can't survive another decade of sustained economic strangulation. For gold, this means the tail risk of outright war hasn't disappeared, but the pressure that has actually been suppressing gold over the past 2 months, the fear that oil-driven inflation would force the Fed to hike again, is starting to show cracks. The moment any catalyst gives oil room to pull back, the inflation fear premium sitting on top of gold prices could come off fast. I want to spend a moment on Ray Dalio's most recent comments, because they've escalated significantly from what he was saying just a few weeks ago. A month or so ago, Dalio laid out a case for holding 5 to 15% gold in a portfolio based on dollar credibility concerns and central bank buying. That case was thoughtful but measured. His most recent framing is neither. He is now saying the U.S. economy is accumulating what he called fatal arterial plaque, and that a cardiac event is a matter of when, not if, the plaque metaphor is deliberately chosen. Plaque doesn't knock you over on a Tuesday, it builds quietly. You go to work, you eat dinner, you sleep fine, and everything looks normal right up until the moment an artery closes, and it isn't. More striking is the historical comparison he reached for. He is not saying this looks like the stagflation of the 1970s, he is saying it looks more like the 1930s. The 1930s weren't just a rough decade for markets, they were debt crises, financial system collapse, the unraveling of international order, mass unemployment, and a shredding of the social contract. He is invoking that era deliberately, and his framework isn't built on a single pressure point. He is identifying 5 forces converging in the same window: debt crisis, political fragmentation, geopolitical realignment, climate disruption, and AI-driven structural displacement of labor. Any one of those would keep a cabinet of policymakers busy for years. All 5 are stacking up in the same half-decade. Here is what stands out to me. Dalio isn't reaching for a new or complicated model. The underlying logic is the same, that serious macro thinkers have been building on for years: dollar reserve status erosion, central bank gold accumulation, the slow-motion de-dollarization of global trade. These 3 threads are tied together, and pulling on one moves the others. A man who has run a major hedge fund through multiple full market cycles, who saw 1987, the dot-com collapse, and 2008, does not casually reach for 1930s comparisons. If he is using that language, he is not describing a risk. He is describing a structural fracture he believes is already underway. I know what a lot of people reading this are thinking. Dalio's framework is compelling, but it is a decade-long thesis. What about right now? Oil is still elevated, the ceasefire is still in question, inflation hasn't been beaten. These near-term headwinds are real. Can gold hold up before they clear? That is the honest tension, and it deserves a straight answer rather than hand-waving a veteran trader. I know from early in my career lived through a version of this in 2003, before the Iraq War. In the week before the invasion, gold was drifting lower from the $380 range. The market consensus was that the war would be quick, oil prices would come back down, inflation wouldn't be a problem, and gold had no catalyst. Traders around him were selling, he was buying. Years later, I asked him why he had the nerve to go the other direction. He said something simple: after the war ends, that is when you find out what the dollar is really worth. What followed is history. From under $400 in 2003, gold moved to nearly $1,900 by 2012. He wasn't clever enough to call the bottom to the dollar. He just thought through what a decade of war spending would do to us fiscal credibility and made a decision based on that. Were there pullbacks along the way? Of course. Did he get caught offside at points? Yes, but the underlying logic held, and holding through the noise was the entire game. The question today has the same structure. If the Iran standoff eventually resolves, if the oil price pressure eventually lifts, what does the re-rating of gold look like with central banks still accumulating, ETF inflows still building, and dollar trust continuing to erode? The inputs are different from 2003, but the reasoning framework is almost identical. Let's pull this down to the technical picture, because the macro case and the price action have to work together. On the daily chart, the downtrend line connecting the early March high to the mid-April rejection has now been broken. Gold has held above that line for 3 consecutive sessions. That matters. It means the weak correction structure that dominated since March has genuinely been disrupted. Bullish momentum is rebuilding and trying to transmit upward into a larger time frame. Zooming into the 4-hour chart, the recent pullback, capped by this morning's gap, has come right back to the $4,660 zone. The area that has functioned as both neckline support and a technical convergence point. That level has been tested multiple times and hasn't broken. Pulling back further to the bigger picture, the bullish pattern base that formed since mid-April, the broken downtrend channel that had been capping upside since the 17th of April, and the double bottom neckline confirmation are all stacking on the 4-hour time frame. 3 separate technical structures pointing the same direction in the same window, what technicians sometimes call multi-source convergence, the kind of signal that tends to carry weight when it shows up. The reason the 4-hour setup matters isn't just on its own terms, It is because a sustained 4-hour structure lays the groundwork for the daily chart to confirm. When both timeframes align, cross-timeframe resonance, the room above opens up materially. On that basis, the next significant resistance sits around $4,890, the last major checkpoint before the psychologically significant $5,000 level. On the downside, as long as $4,660 holds, this is a strong consolidation. If $4,660 is convincingly broken, not a wick through and recover, but a sustained close beneath it, the next support comes in around $4,600, and the consolidation period extends. That scenario would slow things down but wouldn't invalidate the longer-term thesis. There is a line I keep coming back to when markets get complicated like this. A rally is like climbing a mountain. Before you clear the final ridge, every time you look back over your shoulder, it looks like you are about to slide all the way to the bottom. But the mountain hasn't gotten shorter, you've just hit a switchback. The hikers who get off at the halfway point usually aren't out of energy, they've been fooled by what is right in front of them, a steep downhill section, and forgotten how much elevation they've already gained. Jack Bogle, the founder of Vanguard, had a version of this too. He was reportedly still calmly executing index fund allocations on the day before Black Monday in 1987. When someone asked why he wasn't pausing given the volatility, his answer was something like, "If you believe markets go up over time, you don't need a reason to buy in on any given day. If you don't believe that, no price will ever feel safe enough." The question gold is asking investors right now isn't complicated. Do you believe dollar credibility continues to erode? Do you believe central banks keep buying? Do you believe the post-financial crisis version of monetary calm is structurally coming apart? If you do, then $4,660 holding or not is a water ripple. The real question is whether you can see the boulder moving beneath the surface. Whether this morning's gap was a trap or an entry point ultimately comes down to your time horizon and how clearly you've thought through those 3 questions. The people with the answers already loaded don't need to make a decision in the next 20 minutes. The people without answers will be driven entirely by what the next candle looks like.